Hello friends, in this unit we are going to discuss about another financial services, that is venture capital. So coming to the introduction of venture capital is basically a fund-based financial services that has emerged over the period of years to fill gaps in the conventional financial mechanism, focusing on new entrepreneurs, commercialization of new technologies, and support to small and medium enterprises in the manufacturing and the service sectors. Over the years, the concept of venture capital has undergone significant changes. The nascent venture capital industry in India can profitably draw upon the experiences of the developed countries. So as per SEBI regulation 1996, venture capital is defined as a fund established as a company or trust which raises money through loans, donations, issue of securities or units as the case may be, and makes or proposes to make investment in accordance with the regulations. So basically, it is a private or institutional investment made in the early stages or startup companies or new venture. It is the capital which is invested in the business in small amounts or exist only at an initial stage. But these organizations in which the funds are invested are those organizations which have high growth potential with them. So coming to the characteristics of venture capital, we will see that venture capital basically invests their funds for a long term they invest their funds for a long-term horizon. That is, they make investment for at least more than 3 years. The another characteristics of venture capitalist is lack of liquidity. Since as already we discussed that the venture capitalist invest their money for a long-term objective. Therefore, you cannot liquidate that particular amount or capital or funds whenever you want. That's why venture capitalists possesses a characteristics of lack of liquidity. Another characteristics which venture capitalists possess is that is involvement of huge risk. Venture capitalists take huge risks since the funds are invested with the new companies or startup companies or maybe early stage companies which are not properly established, and therefore it does not provide a surety that whether the business is going to be a success or not. Therefore, these companies might be having high growth potential, but there is uncertainty whether the growth potential is really going to be materialized or not. Therefore, a huge risk is involved for venture capitalists while investing in such companies. Another characteristics which venture capitalists possess is equity contribution. Venture capital fund can also contribute in the form of equity. Therefore, whenever the company makes the board, the one of the venture capitalist member will become a board member so that they can basically participate in the policy decision making process and strategic decisions of the company. Further, venture capitalist also possesses the characteristics of management participation since they participate largely in the management of the company, or they become the board members and overlook how the business is going to be better off for that particular new entity funded by them. So therefore, it possesses the characteristics of management participation also. So coming to the stages of venture capital funding. If we see, there are generally 4 to 5 stages involved in the venture capital funding. First of the stage is seed capital, or we can say that it's pre-startup stage or seed capital financing. So first of all, if anybody has a plan to start a new business, then they have a good plan and they have a good project. But it might be the case that they do not have the sufficient money to invest in. So for the seed money or seed capital purpose, they can request or they can get the kind of funding from the venture capitalist. Therefore, it is known as seed capital. So whenever venture capitalists provide the seed capital, the lock-in period is around 7 to 10 years and risk perception is quite high. And it is basically to support the new idea or the R&D of the product development. Another stage is startup stage. When the firm, it is next stage, which is in which the firm is generally established and now they want to expand that particular business for the marketing purpose or development of the more product. So for that purpose they need funding from the different kind of venture capitalist funds, and therefore basically it is known as startup stage. In this startup stage, the lock-in period is around 5 to 9 years and risk is considerably high. For the next stage is first stage, in which the company is already started but they are not able to conduct proper marketing and they are not able to make the proper product development due to lack of funds. So in that case or that particular point of time, this venture capitalist funding is also possible. So in case of first round where they have started producing the product but basically they don't know how to sell the product or how they can increase their manufacturing or quantity of the product. For that purpose they take the help from the venture capitalist, because venture capitalists already know that how the business is going to be, and in that process they can help that company to make that particular business successful in terms of selling and manufacturing. So basically in first stage, your funds are used for initiating operations or developing prototypes. And further companies also need this money for working capital financing for day-to-day requirements. So for working capital financing also venture capitalist funds can be used. So in this stage basically the lock-in period is around 3 to 5 years and this perception is relatively high, and this financing is done for market expansion and enhanced working capital requirement. Next stage, in which the company is already basically established, they are producing but they want to have a new profitable company or they want to go for the expansion of that particular company. So that is your third stage, and in that case also they may require the financing from the venture capitalist for the purpose of market expansion or for the development of a new profitable company. The lock-in period is 1 to 3 years in this case, and which is relatively less and very average period for the investment purpose from the venture capitalist aspect. So they are going for the market expansion, takeover or product development for profit making company. So in that case risk level is relatively low. So now coming to the last stage, that is your fourth stage, where the risk is very less because company is already established in the market. They are also generating profits and all kinds of such things. Only thing is that they need funds for going public or for aiding in public issue. So in that case also venture capitalist fund can be used for such companies, for such stages of the companies. So this was all about the stages for venture capital funding. Now coming to the methods of venture capital financing. See, as we have talked about the concept of venture capitalist and the various stages in which venture capitalists can provide funds to the for the early financing or startup or new ventures. So thus the funds which venture capitalists provide to these startup companies or new ventures, these funds can help a company to survive and grow a profitable venture for a longer period, and such startup companies make use of various methods available with venture capitalist financing for the purpose of getting funds from these venture capital organizations. So first method is equity financing. When a company requires money to finance the startup, which has huge capital requirement with a robust business plan and has the potential to grow into a high profitable venture, the company make use of equity financing. Company offer a percentage of the business or company to the investors in exchange for capital when the company or firm is not able to give timely returns to its investors. The investors who buy share of these companies have a voting rights. Another method is conditional loan. Unlike bank loans, conditional loans have neither predetermined repayment schedule nor any fixed interest rate on the borrowed capital. In this case of conditional loans, an entrepreneur needs to pay the lender in the form of royalty when the company is able to generate revenue or profit. No interest is payable to the lender for the loan amount. The royalty rates may vary between 2% and 15% on the basis of revenue, profit percentage, cash flow of the venture, etc. In the case of conditional loans, an entrepreneur need not pay interest or principal amount instantly, unlike debt financing, where you need to pay back the principal along with the interest within the fixed schedule, irrespective of profit or losses. Now, another method is conventional loans. Unlike conditional loans where the entrepreneurs need not pay any interest to the lender, in case of conventional loans, an entrepreneur has to pay interest initially but with a low interest rate on the borrowed capital. The interest rate will increase as per the increase in profit. Along with the interest on the borrowed capital, an entrepreneur needs to pay a royalty in accordance with the sales or profits. Another method is income note. This is a combination of both traditional loans from the banks or non-banking financial corporations and conditional loans. The key features of income note is that entrepreneurs need to repay the principal amount along with the interest within the predetermined stipulated period. Entrepreneurs need to pay a royalty on sales or profit also. The next method of venture capital financing is debentures. The startup companies generally, in this case, the startup companies generally raise funds by issuing debenture with the guarantee to repay the amount of invested amount when the security is matured. In other words, whenever capital is required, the company issue a debt paper for a specific period of time. Then the company pays out interest on the money invested at a fixed maturity date. Usually, the interest on debentures is payable at three various rates in accordance with the phase of operation or business. Before the commencement of operation, that is the first phase. Second is commencement of operation, low rate of interest. In case of before the commencement of operation, there might be nil rate of interest, whereas in commencement of operation, after commencement of operation, a low rate of interest may apply, and after reaching a particular level of sales of profit, a high rate of interest may apply. So there are two types of debenture the companies offer, namely that is convertible debenture and non-convertible debentures. Convertible debentures can be converted that enables to convert the debt into the equity shares which have the ownership right. While in case of non-convertible debentures, the company does not convert the debt into equity shares. Further, coming to the advantages of venture capital. Venture capital funds are one of the most significant funding option available to the new startup companies. Entrepreneurs with innovative ideas may have trouble finding traditional financing, but with the help of venture capitalists, you can get an access to funding, since these venture capitalists are willing to take a risk on unproven ideas or proven ideas. So next is, these venture capitalists also bring expertise in addition to the funding to the business, and they offer valuable business expertise and connections to help a startup grow and succeed. Further, venture capitalists provide long-term support to their portfolio companies. This support can be included into form of additional funding, guidance, or access to network of resources. Further, it helps to reduce the risk, since venture capital is a riskier form of financing than traditional loans. So it can also reduce the risk for entrepreneurs. Since venture capitalists benefit from the startup success, they may be more willing to work with entrepreneurs through difficult times. Further, venture capitalists also help portfolio companies in gaining exposure and publicity through their networks and connections, and thus they help in the marketing and publicity for these companies also. Further, coming to the disadvantages of venture capital. Venture capital, basically when a company accesses venture capital funds, it leads to the dilution of control. This is one of the major drawbacks while accessing for venture capital funds, since entrepreneurs may have to give their significant amount of their company shares to secure funding from these venture capitalists. Further, Venture capitalists expect a high return from their investment in these companies, therefore they pressure the startups to succeed quickly. Therefore, it can be stressful for entrepreneurs and lead to short-term decision making. Another thing is that securing venture capital can be time consuming and it distracts entrepreneurs from other critical aspects of their business. Venture capital is also an expensive form of financing, leading to high cost to the startup or new ventures. Therefore, entrepreneurs may have to pay higher interest rate or give up a large percentage of their company in exchange for the funding from these venture capitalist organizations. Further, venture capital is not an option for all businesses. Venture capitalists are often looking for high growth startups with innovative ideas and may not be interested in more traditional businesses. So it is limited option for only some of the companies. Now coming to the differences between private equity versus venture capital. So first thing is that private equity are the investments that are made in those firms which are not publicly listed on any stock exchange. Whereas venture capital refers to financing of small businesses by the investors seeking high growth potential. In case of private equity, funding is stage of investment is later stage, whereas in case of venture capitalists, they are investing in the organizations in the initial stages of the organization or the venture. In case of private equity, investments are made only in few companies, whereas venture capitalists may make investment in large number of startup companies or new ventures. In case of private equity, funds are provided to the mature companies having good track record, whereas in case of venture capitalists or venture capital organizations, investments are made up in the startup companies having high growth potential. In case of private equity, the investors focus on corporate governance, whereas in case of venture capitalists, they focus on management capability of the organizations. Private equity might be available to all the industries, whereas venture capital is available to the industries that require heavy initial investments like energy conservations or high technology extra. Private equity risk involved in the private equity is quite less, whereas risk involved in the venture capitalist is high, since they are investing in the new businesses or new ventures where they are not certain about their growth or success. In case of private equity, funds are required for the growth and expansion of business, whereas in venture capitalist, funds are required for scaling up of operations. In case of private equity, ownership of the investor is generally 100%, whereas in venture capitalist, the ownership does not exceed from 49% in the company. So this was about the difference between private equity and venture capitalist. Further, we are going to discuss the difference between angel investors and venture capital funds. So before coming to the difference between angel investor and venture capital funds, let us have a brief knowledge about the angel investors. So angel investors basically refers to an affluent, accredited individual who invest their own money in startups or companies in the early stages of development. This is in exchange for the equity in that startup. Angel investors may also contribute their business expertise to help the company, but they are generally content with receiving an equity stake for the funds they contribute. So what is the difference between, when we compare, then what is the with venture capitalist, then what is the difference between angel investor and venture capital funds? Angel investors are affluent individuals who invest their own money into startup ventures, whereas venture capital investors pool funds from third parties to finance the startups or new ventures. A venture capitalist can be described as an investor in private equity who lends capital to companies with high growth potential in exchange for equity stakes. Whereas angel investors are people who offer promising startup businesses funding by offering a share of the company, generally as royalties or equities. Angel, angel investors are people who offer promising startup business funding by offering a share of the company, generally as royalties or equities. Venture capitalist firms invest a large amount of money, whereas angel investors invest a small amount of money, and also venture capitalist investors gets a higher equity stake in the company in comparison to the angel investors. Angel investors frequently adopt a hands-off strategy and do not actively participate in the company's operation. Whereas on if we see venture capitalists frequently support the management of the businesses they invest in, both from the strategic point of view and operational point of view. Angel investors often have a longer investment horizon and can withdraw their money through an initial public offering, merger or acquisition. Conversely, venture investors often want to sell their investments within a period of 5 to 7 years through an IPO or acquisition. Angel investors tend to have a more diverse portfolio since they invest in a number of companies, while venture capitalists may have a concentrated portfolio with a focus on a specific industry or sector. So this was the difference between angel investor and venture capitalist funds. Thank you. This was all about venture capitalist and their role in financing the startup or new ventures. Thank you.